Wall Street economists spent the weekend gaming out the impact of the renewed trade dispute, mostly reduced their outlook for U.S. and global growth and increased their outlook for central bank easing. The problem, gauging these impacts is hard enough. They also have the problem of putting probabilities on the outcome of political talks, how long it all lasts, how equity markets respond, and how the effects of all this on business confidence and capital spending. J.P. Morgan writing the trade war could hold global capex growth to zero this year and damp China GDP by 0.8%. Conflict escalation also would amplify easing bias across the globe. That means central banks. Goldman Sachs sees a worst-case scenario risk to the U.S. growth of 0.4 of a point, and even more if equities take a big hit. Its report cites recent academic studies finding that U.S. businesses and consumers pay almost all of the price of increased tariffs. All of this leads Morgan Stanley to forecast serious Fed easing if the trade battle lasts 3 to 4 months longer. Morgan economists see more Chinese stimulus and 50 basis points of cuts from the Fed because of these tariffs.
Wow. 50 basis points?
As a starter. And it's interesting, Becky, that while you're raising prices, and this is something I think we have a special guest coming up on,
right,
almost all of the forecast impact is deflationary.
Right.
It's lower growth. It's ultimately lower prices, lower confidence. There is no, and I can give you one economic reason for that. Tariffs end up being a one-time rise in the price level. So let's say you slap, there's that word again.
Yep. You slap it.
A 25% tariff on, prices go up 25% the one time. The next time, they don't go up unless you change inflationary expectations and create an inflationary cycle, but it's a one-time rise in the price level, and that could ultimately, because you've raised prices, cause incomes to decline and another aggregate growth to decline as well, aggregate demand to decline as well.